If you invest in global tech companies, Intuit, ticker INTU, is probably on your radar as one of the most resilient businesses in the world. Owning brands like QuickBooks and TurboTax, their ecosystem is practically a toll road that small businesses and American citizens pay every year. But when we change our view to 10 years, the scene changes. Will the economic moat that has protected Intuit until now withstand the biggest disruptive forces of the decade? In this video, we'll look at the 4 big risks that every fundamental investor needs to watch closely in Intuit's plan for the next few years. If you want to understand what could threaten this giant in the long run, subscribe to the channel here, and let's get straight to the analysis. Risk 1. Commoditization by artificial intelligence. The first big risk is disruption and commoditization by AI. Intuit is investing billions to put artificial intelligence and smart agents into its platforms. But here's the puzzle for investors. The very nature of AI could destroy the value of traditional software. In the next 10 years, advanced language models and smart agents will be able to understand tricky tax laws, sort out spending, and organize cash flow almost for free. If any new startup can connect a strong AI layer to a simple financial database, the money Intuit charges for its QuickBooks and TurboTax subscriptions could take a big hit. Well-known Wall Street experts are already warning, AI could greatly lower the entry barriers that used to protect the company. Risk 2. Government disintermediation, the IRS factor. The second risk is political and about rules, and it directly affects the company's cash cow, TurboTax. We're talking about government disintermediation. In the United States, the government has been expanding the pilot program for IRS Direct File, a public, digital, and completely free system for individuals to file their taxes. If we look at the next 10 years, the unavoidable global trend is for taxes to be filled out automatically, where the tax agency sends the ready-made return and the citizen just approves it. If the American market widely adopts this model, TurboTax's revenue from the general public will see a drastic structural drop. Signs of this sensitivity to prices and government competition have already started to appear in the company's recent reports, and long-term investors cannot ignore this. Risk 3. Execution challenges in talent transition. The third risk is internal, the execution of the big restructuring. To respond to this new tech era, Intuit's leaders took a big step. They cut about 17% of their global workforce in a large layoff. The goal? To make room and money to hire people focused purely on AI, replacing a traditional software engineering gear that works perfectly with one based on smart agents brings a huge risk in how it's done. Also, in finance and accounting, there's no room for mistakes. An AI hallucination that causes a widespread error in tax calculations for thousands of companies could destroy the reputation of brands that took decades to build, and also lead to billions in legal problems. Risk 4. Small and medium business saturation and vertical competition. The fourth and final risk lies in QuickBooks growth, saturation, and vertical competition. To keep the double-digit growth rates that the market demands, Intuit needs to move into the mid-market, but that environment is much more competitive. To make matters worse, specialized software for specific areas, like Shopify for e-commerce or Toast for restaurants, are adding their own financial and accounting tools. As these special platforms grow, many small and medium businesses no longer need a general system like QuickBooks. Add to this the big-picture economic risk. During long periods of high interest rates or a downturn, small businesses are the first to close, directly affecting Intuit's regular income. The conclusion for us investors is clear. The big test for Intuit in the next 10 years isn't a lack of money or data. Their current cash flow is still amazing and the business is strong. The real risk is how fast things get replaced. Intuit needs to be quick enough to make money from its new fancy AI tools before tech rivals and the American government can chip away at the value of its old software. As an investor, do you think Intuit's strong advantage is still enough to overcome these threats? Or would you rather stay away from this idea in the long run? Let me know what you think in the comments below. Don't forget to hit the like button if this content helped you understand the asset better, and I'll see you in the next video. Until then.